Welcome to our explainer. You've probably been told your whole life that dividends are this ultimate master key to a life without work, right? The perfectly safe, time-tested path to passive income. But what if everything you thought you knew was actually hiding a deep, rotting foundation beneath the surface of those tempting high-yield numbers? Hidden possibilities suggest that the very safety net you've been taught to trust might actually be a deeply dangerous illusion.
Okay, let's dive into this. When you see a massive, flashy number, like a 9.8% yield, just flashing in green, it feels like a massive victory, doesn't it? You think, wow, I've totally beaten the system. But hidden mechanics reveal that this initially promising number is often nothing more than a ticking clock, silently counting down to absolute zero.
And this brings us to a deeply terrifying question. What if the income you think you've secured is actually the exact reason your investment is about to vanish into thin air? Historical market shadows suggest that most investors believe they're buying their financial freedom, when in reality, they're actually buying a seat on a rapidly sinking ship. That massive dividend yield isn't some generous reward. It is often a blaring red distress signal from a company standing right on the verge of bankruptcy. And this brilliantly illustrates the fundamental trap of the market. When the hollow core of that struggling company finally gives out, the dividend inevitably falls. And when the dividend gets cut, the stock price crashes right down with it. You're left staring at the grim reality of chasing bad yield, $0 in income, and a portfolio decimated by $50,000. The cash flow you chased just evaporated, taking your hard-earned wealth right along with it.
So how do you actually escape this trap? To survive, must you fundamentally stop investing in income and start investing in strength? Hidden market truths reveal that if you're investing strictly for the paycheck, you are completely ignoring the architectural strength of the company writing that check. We must completely shift our paradigm away from the hollow core of high income chasing and anchor ourselves to a deeply resilient foundation. That resilient foundation comes in a very specific form, the ETF, or Exchange Traded Fund. Think of this not just as a standard investment, but as a financial shield. It protects your wealth by acting like an evolving, living organism. If one single company behind your dividend begins to fail and die, the shield automatically removes that failing entity, seamlessly replacing the loser with a fresh, resilient winner. Your portfolio survives, adapts, and endures, and you don't even have to lift a finger. You can see this strength really clearly in the core of the American economy. Some funds focus on absolute royalty, companies known as the aristocrats. We're talking about funds like SCHD or NOBL, which focus entirely on giants that have continuously grown their dividend payouts for 25 consecutive years or more. We're looking at decades of unbroken, clockwork reliability, literally building the very foundation of generational wealth through sheer consistency. But as you look at these invincible aristocratic giants, a new mystery emerges. Is there a hidden ceiling to your wealth if you don't use the invisible engine? You see, even the safest, most towering giants in the market have structural limits to how fast they can grow. An unseen market forces suggests that without unlocking a much quieter, hidden engine, your wealth will inevitably hit a glass ceiling, stopping you just short of true financial independence. So let's get into unlocking the invisible engine. Now, some believe the safest giants hold all the wealth, but hidden possibilities point to rising stars. The true explosive wealth isn't hiding in the safest megacorporations everyone knows by name. The real secret actually lies in the shadows, within mid-cap companies valued between $2 and $10 billion. These are the companies that are still aggressively, hungrily growing. Now, what's really interesting to see here is the sheer velocity of that growth. Mid-cap growers frequently offer greater than 11% annual dividend growth. Funds like REGL or PEY specifically focus on these rising stars. By targeting this exact sweet spot of the market, they unlock an explosive income expansion that goes far beyond what those sluggish, aristocratic giants could ever hope to provide. They are the true invisible engine of a growing portfolio. But unlocking this engine requires a trait most people completely lack, and that is unyielding consistency. Think about it. What if a terrifying market crash is not a disaster, but the ultimate golden gift for your retirement? We are so conditioned to panic when the screens bleed red, right? But hidden market psychology suggests that fleeing in terror is precisely how you lose your income forever. The secret to capturing that gift is the ABB strategy. Always be buying. It's the calm, deeply disciplined act of acquiring more income for a significantly cheaper price during widespread market panic. When the whole world is terrified, the consistent investor is calmly filling their cart. They aren't running from the storm, they're actually using the storm to buy more cash flow, capitalizing beautifully on the fear of everyone else. Let's look at the mathematical reality of this consistency. Imagine a simple baseline, a $1,000 monthly investment. If you secure a steady 8% growth rate alongside a 4% dividend, over time you build a massive $1.5 million portfolio. That alone is a staggering, life-changing number that perfectly proves the power of patient, disciplined investing.
But what if you never touch that money? By activating DRIP, the dividend reinvestment plan, the exact same investment doesn't just grow, it violently explodes. By automatically feeding every single dividend back into the engine, that $1.5 million portfolio doubles to over $3.1 million. It's the exact same initial investment, completely transformed into a financial behemoth through sheer patience.
So the crucial point is the staggering difference in your actual life. On one hand, you have a very respectable $5,000 a month in passive income. But by utilizing the invisible engine of compounding and reinvestment, you are now generating over $11,700 every single month, all because you allowed the machine to quietly run in the background, untouched and unhindered over time. Which brings us to the final growth illusion. You really need to be aware of the high-risk covered call ETFs out there, like JBQ or JPI. They flash these neon signs promising double-digit income today. They rent out your stocks to traders for instant fees. But in exchange for that quick cash, they critically, fatally cap your growth in a booming market. It's like a heavy vault door slamming shut on your future wealth, just to hand you a few dollars today. Let's move to and see how this builds, because ultimately, hidden metrics indicate these are short-term plays that severely lack the compounding power to turn thousands into millions. These are trading tricks, illusions of wealth that will just leave you stagnant. The real path to replacing your salary isn't found in a quick fee. It's found in the patient harvest of true, uninhibited global and domestic strength. You see, the grand lie of passive income is that it's easy and immediate. But the profound truth is that it requires sacrifice, consistency, and deep vision. So as we close our explainer today, I want to leave you with this reflection. Look at your own strategy. Are you just chasing high-yield numbers on a screen, or are you building a resilient legacy that pays you while you sleep? The choice between the temporary illusion and the permanent engine is entirely yours.